财务长，我是这样选子集，是第一个都是直接不签算对不对？他在讲话的时候，每个礼拜都已经被他点。我觉得他好像想要发现我的状态。
This case we talk about during the year 2008, 2009, year 2009, the financial tsunami. A fund manager is called Rudy Wang, and he was facing his client and trying to withdraw their funds from the company. So here, make some statement to way or maybe recommend his client can switch investment, etc. And so it's a very interesting case, especially the background of the case is about the year 2009. And there was during crisis. Same here, same now. The now is the inflation crisis and the Ukrainian crisis. And this case the scenario is quite similar. And because nowadays also if investor want to withdraw their fund from the market. Okay, about earlier on we talked about the company analysis, and we also have to evaluate the company risk. And here we say the company with a weak balance sheet, that means the high interest rate and the high leverage, probably is easy to be influenced by the market factor. So, for example, nowadays the market was pretty good, pretty bad. So the company with the weak balance sheet will be suffering first. And the company with the bad management also has a high risk. So when we evaluate a company, we also have to evaluate the management ability and integrity level. Should also be considered part of risk factor evaluation. And technically, when we do the fundamental analysis, probably in addition, we also have to do some technical analysis. But the technical analysis is part. I'm not going to teach in this class, but the book has, we have one chapter talk about this. And basically, about investment, and we have the so-called fundamental, like we just introduced earlier. And there's also called technical analysis. It's based on the historical price behavior of securities, and also called momentum investing. Okay, technical analysis are called momentum investing. And there is the hypothesis is very popular, also well received. There was the book published, I think about 30 years ago, about the random walk hypothesis. Here, this book talks about the stock price movement of absolutely no help in predicting the future movement. The stock price is a random process. It's a random process. And actually, personally, I more believe in this. But I still think that the technical analysis for a short period of time can help you to evaluate the market momentum. So we also talk about momentum investing for a short period of time, but not always rise. But so the reason I support the random walk hypothesis is because actually, as you know, the share price primarily reflects the future event, future information in the future. And technical is more based on the historical price behavior. That means already reflect in the share price. And there are several models we can evaluate a company. Remember, I asked you how do we come up with the interest value. Normally they use those models. Discount cash flow, like present value, net present value, right? P ratio, book to book ratio, market cap over revenue ratio, and the cost ratio. There are also some modeling that I mentioned. I talked in last semester about the EBITDA margin. But EBITDA margin probably is more used for the merger acquisition situation. And normally when it comes out, the company value probably within a range, not a single number. Right? If you say the Apple computer is got to be 200, this point, single point. I don't think, if we're saying this, it's quite risky. So normally for those fund managers, they make a recommendation range. But they will say, in certain situation, the Apple computer will be within the 180 to 210, something like that, right? And they will tell you this company is underweight or overweight as well. The probably more likely they will tell you about the rate rather than a single number. Because single number, I don't think it's not easy to get a number. And most of the time I'm not right. And here I told you the impact of the political event, including this Ukrainian and Russian war. And all you can see, like for example, like in year 2016, because the investor was so a little bit concerned about the China economic future. So there was a drop, but then up. And in year 2016, there was the UK Brexit, right? And down and up. And Donald Trump became the president. And the market was so a little bit concerned about his policies and his personal characteristics. And market went up. And the French election also had some impact. And there was the Catalan independent movement. Okay, this is Spain. Although it's down, but up again. So probably those predictive events will affect the market maybe like 2 months, 1 month, or 1 quarter, and the market will still depend on the fundamentals for the longer term. So this time, now since the beginning of this year, the market was down. For example, like Nasdaq already down more than 20%, and Dow Jones probably down like 12%. So in the market, if it's down more than 20%, considered to become bearish market. 一般如果跌2成算熊市。But recently, I found some expert they kind of don't believe this number. That they say probably 30%, down 30%, become the bearish market. Probably is more acceptable market argument. Remember in the year 2020, when the pandemic just beginning outbreak, and the stock market down, I think more than 30%, but finally also up. So this is just one signal. Does not mean every time it will be like this. And let's talk about the COVID-19, right? Those flu. Okay, show you like for since the 1970 up to now, those like flu or SARS or like Ebola or like now is the Ebola, right? And the Ebola and now is the COVID-19. Definitely the market will be affected, but for the long term, they will be affected on the fundamental and the liquidity. Value investing, we talk about this, right? And so we are here. And possible routes to make profit. One is you benefiting from a rise in the asset intrinsic value. The problem is that increasing value are hard to predict accurately. Like we know the company, the cash flow will be good, everything is good, and so the interest rate will be upping, so we will get in from the interest rate. And but the problem is, as I mentioned, the cash flow is hard to predict accurately. The second way to make an investment policy is applying leverage. The problem is that using leverage, buying with borrowed money doesn't make anything a better investment or increase the probability gain. I don't think that using the leverage is a good idea. Although, for most of the investment tycoon, investment that make those very, very, I'm talking about extremely successful investor. If you take a look at their history, or you read their biography, one of the reason they can become so rich, or if they are using leverage. But I would say this, the luck. But personally, I using leverage, but my experience is most of the time when I use leverage, the outcome is not good. The better is using just using your cash to buy the stuff, because especially now the market is so up and down. Normally, if you are using a leverage, that means you borrow money from security firm to make investment. If the stock price drops, probably more than 25% or 20%, you will receive a margin call from security company. And there's a pretty chance drop even further. So if it drop, maybe more than 30%, probably all your initial money, your initial capital will be gone. So actually it's quite risky nowadays. So I don't recommend applying leverage. Selling for more than your asset worth. Okay. And this is one way to make it very, very easy. Right? And buying something for less than its value. This is the value investing, right? Buying something for less than its value. The most dependable way to make it. Okay, so if you have a capability to evaluate very accurately the interest value, and if the market price is much lower than interest value, probably it's a good time for you to buy. Next. Actually, for the second part of the investment concept, and actually I prepared a lot of slides, but for the time constraint, I only choose, I rearrange my slides. So now I only have a few slides available, just tell you the key points. And this slide we're talking about like the spiritual capital is more like a psychology, investment psychology. Remember I told you the two most important things is liquidity and psychology. Okay, in addition to the foundation. So I'm going to go quite quickly. So the crucial point of investment, management, and living philosophy. And for the management and the living philosophy, I didn't do it here because there was too much. Now we more focus on investment. This is the intelligence and the intuition. I think intuition play a large role in investment. So probably, as Warren Buffett is saying, investing is not for the most intelligible person. Based on his saying is, if your intelligence level is okay, it's above average, and your psychological factors are strong. In China, psychological factor we call 心理素质，对不对？你的心理素质如果强，你的智力啊，大概中等以上就可以了。通常成功人蛮多是这种，你
外语最聪明，最聪明的不当的人，因为他很聪明，他很会分析，精心计算。可是一个他通常他的个性比较不适合，他的个性比较不适合。就像你看那些创业的人，不见得最聪明，创业不见得这样，创业就是那种个性，然后打不死的仗，然后勇往直前，然后甚至有点偏执。OK。
And in finance, right, we have the modern finance. Modern finance you learn from your corporate finance. Right? You learn about like based on assumption of the rational expectation, right? And homogeneous expectation. Remember, we came up with like a CAPM. We came with the market efficiency. We came up with the efficient frontier. We came with the dividend policy. We came with the capital structure. We came up with like a net present value, and we also all kind of the things we learn from the modern finance. So modern finance assume the human being have perfect rationality. But nowadays the behavioral finance or financial behavior became, I shouldn't say more popular, but that would be, supplement each other. You are not only because this is the assumption is not reflect the real situation. And so nowadays is the finance behavior is more concerned about the human factor psychology. So in the history, in the past, the modern finance also developed a lot of model, quantitative model for you to evaluate, right? Some of them are useful, right? Like a CAPM and like a APT and like a option pricing theory. Those are useful. Also could be used in the real world. But in addition to those fundamental development, also they have further sophisticated model of development. But actually those sophisticated ones cannot solve the real problem. Because those sophisticated models also provide you based on a lot of additional assumptions. So nowadays is more considered about those human beings. So human beings have limited rationality, including limited thinking, ability, limited emotion, and limited willpower. 就是你的毅力的 willpower. And the key point is the market behavior of the price and quantity, right? In the modern finance, we talk about price and finance, and if the demand is oversupplied, then price will up, right? And here is more like including personnel, organization, and the markets. This factor focus on factors related to one's behavior, the environment, among others. For example, the modern finance behavior that we evaluate, some students we mentioned about. In the past, we more focus on price and quantity, right? The cash flow, something like that. And nowadays, they also evaluate the experience of the CEO, the experience of the management team, and the agency problem of the management team. And those factors also affect the share price, not only just quantitative. You understand? And the modern finance is focused on financial behavior related to market behavior of price and quantity, emphasize on capital market and the corporate finance. And behavioral finance is more focused on the finance behavior that treat human beings as a central issue of consideration, emphasize on the personal financing behavior, and gradually expand to corporate and the market. Okay, those are the common psychological bias. Now we are talking about behavioral finance, right? Among general investors, loss aversion, they didn't like loss. So if you buy 100%, $100, now the share price become 80. Most of the time they will just keep it. They didn't like loss. Keep it, waiting for the price to rebound.
maybe in the long term. If the price you buy at 100, but now become only 10, probably you will sell instantly. Because you don't know later on maybe the price will drop again, so you will, but you didn't like loss, so when the loss happens, you keep just treat it as a long-term investment. And mass market behavior, I'm talking about like Warren Buffett said, when the market became like a very greedy and investors should be fearful, the market become fearful, investors should be greedy, something like that. So it's like mass market behavior. We call it contrarian, against the market belief. Nowadays, like a market became so panic, probably maybe you can become like more aggressive. But as I mentioned 2 weeks ago, at this time, probably stay away from market is better. Don't predict the market because now the environment are so different. So you'll be better to wait for maybe another 1 month and happy again. Overconfidence. You will overconfidence. And mental accounting. The mental accounting, for example, is that means that every personnel, whether you are an investor or you are, a career woman or someone working in the company, and you have different sources of income. Right? You have the income from every month your salary, for example, like 40,000 a month, right? And sometimes you will receive the year-end bonus. And so the human being, normally they have the different accounting ledger. Okay? This ledger is for regular income, and this is for like a bonus, and the other is for investment gain, investment return. So you want to buy a very nice bag, right? Then you want to buy like a Chanel or Prada, etc. Right? Probably you are not going to use your regular account. Probably use like investment gain or bonus. Understand what I'm saying? 好，这个每个人有这种各种账户啊。通常你要先买那些奢侈品，你会用那种赚钱来的，投资来的，不会用你的固定的那个什么钱。So this is mental account， 心理账户。Framing effect. That means you have preoccupied, questions, thinking. For example, you want to buy a what you want to buy? Oh, you want to buy a clock, right? And if you, for example, $50 US, just assume, and you can pay if you pay cash, you will pay 50. If you're using the credit card, probably you pay 56, for example. And this is one option. And if you option 2 is the clock is the pricing was 56, but you have to pay credit card. But if you pay cash, you will get 50. So this is different pricing. One is pricing 50, but you pay cash, but 56 you pay this. And the other is just
pricing higher, you pay 56 and you pay cash. You think investor probably will prefer what? And you know, the psychology professor, they do the statistical analysis, and they say the framing effect, and you know, for both cases, you pay cash, you pay 50, right? But different pricing strategies, and probably they will prefer like this, because this, they feel they have gained something. They pay cash and they get a $6. So it's more like a psychological thing. How to deal with psychology biases? I think at the mainland it is possible for one to make a wrong decision, okay? And recognize I'm not special, and get rid of stereotype behavior and realize that minor mistake does not necessarily represent the majority. Build up evaluation criteria objectively and reject emotional and subjective influences. And cultivate the habit of thinking positively and deleting negative thoughts, thus returning to a neutral point of view when assessing a situation. Set clear and ultimate goal and build strict and strong self-discipline. This is just tell you how to deal with. Is saying is easier than done, right? Saying is easier than done. And for the good investor, and probably you have the patience, discipline, insulation, and treat investment as a business. You know, let me give an example. I knew one guy in Taipei, and he's very successful investor. He's a doctor, and you know, he's very disciplined and very enthusiastic about investment. So he woke up very early and read a newspaper, and then he's just an individual investor. He's not portfolio manager. He's a physician, doctor, medical doctor, and because investment becomes successful, so he didn't want to be a doctor anymore. So he has the time to make further investment, and when the stock market opened at 9, and he watch the market, and also conversation with his friend and also his information source. And after 1:30, the market was closed, and he will take a nap, but then he will read the news after market. And there are a lot of news after market, right? Because after market, you want the computer screen will show you like who are buying, right? Institutional or individual or foreign shareholding buying, how much they are buying today, right? And after market, there may be some announcement happen. So although he is doing investment, but he is going to the market at a very early morning. Then he of the market is even later than 1:30 when the market was closed. So maybe I remember he said that maybe after 5 o'clock he finished. But in the evening he have a chance to talk to his son, like a fund manager or information source, and a dinner together, and he can get some more information. Something like that. Okay. Introspection. The middle one is what? Balance, open-minded, humble. So it looks like you want to become a good investor, you got to be a sacred man, right? 好像一个要当圣人一样什么都要那个。大部分这个其实每个人都有他的缺点，像这里面有很多部分我都没达到。Okay, this is the cited from the Howard Marks book. This mentioned the share price is like a pendulum. It's like a like a clock, a pendulum, right? And go left and down. So go left, that means euphoria, party oil price, and down depressed, negative and underpriced. And only a few times, limited time here is equilibrium. Most of the time just over or under. So definitely you want to buy the under price. The argument like this, the investment market is follow a pendulum-like swing between the euphoria and the depression, and between the celebrating positive development and observing over negative, and that's between overpriced and underpriced. And several elements lead to an incorrect decision. Earlier we talked about positive, like the discipline and the inspiration and open-mindedness, and here you talk about incorrect decision. Greed, fear, willing suspension of disbelief, and tendency to conform to the view of the herd. Envy, tendency to compare ourselves to others, and it is the impact this can have. What should be constructed and what's envy? Envy happens all the time. You have money, your friend has money, and you are conservative, so you didn't make this investment, but your friend make investment, and he make a lot of money. Inside your mind, you make jealous of him. And so the human being is, if compared to investment losses, probably I'll be more concerned my other investor or my friend making money than I was losses. Understand? 有时候你看别人赚钱呢，比你自己赔钱还不爽，这是人性。有时候会讲这种概念，你不要说老师在讲，老师你是太小气，不是，这是人性，人性。Ego, investing, especially poor investing, is a war pool of ego. Since this feeling is rewarded in driving market, ego can make investor behave aggressively in order to stand out through the achievement of information. Investors go to their conviction as long as they can, but when economy and the psychological pressure become irresistible, they surrender and jump on the bandwagon. I think that a lot of information from the Howard Mark, I think I really recommend you to read this book. They have a Chinese version. How much time? Financial market, we have the money market, capital market, currency market, financial derivative market. For those respective market, we have those things. Okay, this is just very common sense. And not just for your reference, this is the talk about some example like in the year 2015, the market became just functional. And this is more like talk about like the fundraising. I think we talk about this a lot in the last semester investment banking class. This is so-called shadow banking, 影子银行，大陆承认。影子银行就商业以外的商业银行以外的金融行为，那影子银行，像投资银行、money market，就大陆叫shadow banking。Okay, here just this also from the most important thing. The three stages of bull market. Right? The first, when a few forward-looking people begin to believe things will get better. The second, when most investors recognize investment improvement is actually taking place. The third, when everyone concludes things will get better forever. This is the bull market. But the problem is hard to judge each stage. The three stages of bear market. The first when just a few stocks investors recognize that despite the prevailing bullishness, things won't always be rosy. The second, when most investors recognize things are deteriorating. The third, when investors, everyone thinks things can only get worse. Okay, this is the three stage. He mentioned about the market situation and using the three stage framework of Wallace. This is cited from the most important things. Okay. Maybe we still have a few time to talk about the investment theory. As I told you before, and because most of the theory probably learned before, so we only briefly talk about those. Okay. When we talk about investment theory, basically we talk about risk and return, right? Risk. Then we learn about the risk and return. Then we learn about the coefficient of those return or those risk and some coefficient. Then after we learn about the coefficient of all those risk and return factors, then we come up with CAPM, right? Because CAPM is tell you the relation between risk and return. Using a very nice way and very easy, simple way, tell you the return is based on risk premium plus equity premium. And what is equity premium? Equity premium is the beta time market return minus risk rate, right? You all remember this, right? Then the investment theory also tell you about the market is efficient and but not always efficient. For the general market, like a US market, the market probably is like a semi-strong form efficient. The Taiwan market, I would say for large cap stock, like a TSMC or Media General, Denmark, those probably is like quite efficient, semi-strong efficient. But for small cap, I don't think they are efficient. They are probably is weak form efficient. But for efficiency, we talk about three forms, right? Strong form efficiency, semi-strong form efficiency, and the low efficiency. The strong form efficiency, that means the share price will reflect all the information, no matter inside or outside information, right? Or public available information. And semi-strong form will tell you about like only reflect public available information. And weak form is tell you is only reflect historical information. So actually, and then investment theory will tell you about the efficient frontier is something like that, and come up with some like a portfolio management idea. And we'll talk about portfolio management later. Return risk, right? Definition of major risk. We talk about the risk including the market risk, interest risk. Now the interest risk is very, very concerned. Currency risk, like the Russian, the currency risk. And even Taiwan also now has some currency risk because the Taiwan dollar depreciate and appreciate US dollar. Inflation risk, purchasing power, credit risk, default rate, operation risk, and liquidity. Okay, so we are not going to spend time. So it's some how mark. You can read back this thing. And we talk about standard deviation, right? Before. And we come up with the beta, remember? And the beta measure the systematic risk. And the non-systematic risk will be diversified. If we are holding only like a steady stock, how you diversify most of the non-systematic risk and only systematic retain, right? This is the investment theory here. So the beta coefficient is used to measure systematic risk. The standard deviation is a measurement of the total risk, which is non-systematic plus systematic risk. But as I mentioned, this will be diversified if you got enough stock or asset in your portfolio. This is also cited by Homa. In the finance class, this looks very familiar, right? Here I tell you the risk and the return. In the high finance, we always assume if you are bearing higher risk, you will get a higher return, right? If you are bearing lower risk, you are bearing return. Is this always true? By theory, it's true. If not true, then no theory. This we call Xn time. Xn time. Xn time. Xn time means before things happen, right? Xn time. 事先的 Xn time, the high risk, high return, low risk return sounds very logical, right? How about ex post? 事后呢 ex post, after the fact, not necessary. After the fact, maybe like this. This also show you, this is by, is a invention by this author. He said, from the real world, he more believe this relationship. This relationship tell you the risk and the return is like this. But most of the time, the behavior will might like this. That means the higher risk can mean higher volatiles. Right? Could be making money here, or they could be losing a lot of money. So the higher risk means more volatile. This is why his argument. So he mentioned about the risk is like this. Okay, I think this is a good idea. I think in the real world it's more like this. You are bearing higher risk, then you are bearing a more volatile. For example, you buy the small cap stock, 小型股 small cap stock. It's higher risk, but you could make higher return. Especially you invest in a disruptive innovation stock, or is strong stock. But the problem is their cash flow also very volatile. Sometimes good, sometimes bad. So you become more higher risk. If you buy the treasury bond, the risk is very, very small, very limited. Still some risk, inflation risk, but very limited. And here I tell you the risk return and what are those assets. If we invest the venture capital, they have invested in the money market, and they will grow. And risk will shift. The slope of the shift because of the market situation. TIF, this Taiwan it's happened like several years ago. A lot of Taiwanese purchased TIF. Those investment assets were introduced by investment banker, and I think they are quite. Basically this is the